Hello everyone, welcome to EduTap and welcome to today's session. So today we are going to discuss two very important news articles. So this is also the RBI press release and this is also the RBI notification. Okay, so today we are going in the Finance 360-degree session. We are going to discuss these two very important news articles, and they are in the RBI website also, so you can understand that how important they are. So first, we are going to discuss the RBI and the Bank of Mauritius. They have signed a memorandum of understanding, so we will be discussing about it. It is a small press release released by the RBI. Then we will be discussing another very important topic for today. That is the RRBs have got 5 more years to amortize the additional pension liabilities. So what is this amortization that is going to happen, and what is this additional pension liabilities? What was the announcement by the government, and what the decision has been taken by the RBI? All of this we are going to discuss in today's session. And both these news articles are very important from your understanding perspective, from the examination perspective. Okay, so good morning to all of you and welcome to the session. I hope that everything is fine. I'm clearly audible and visible. So if there is any problem, if there is any issue that is coming, do tell me. And let's get started. But before that, do subscribe to the YouTube channel of EduTap and do join our Telegram channel for the PDF of the session. And the link for the Telegram channel is available in the description box below. Okay, so give me a thumbs up if everything is fine. And let's start with the first topic for today. That is the Reserve Bank of India and the Bank of Mauritius. They have signed a MoU. Now this MoU has been signed to promote the local currency. Okay, so the RBI and the Bank of Mauritius, they have signed a MoU for establishing a framework to promote the use of local currencies, that is the Indian rupee and the Mauritian rupee for cross-border transactions. For the transactions between Mauritius and India, it is said that the local currencies will be used rather than dollars. So the MoU was signed by the Governor of the Reserve Bank of India, that is Shri Sanjay Malhotra, and the Governor of the Bank of Mauritius, that is Dr. Rama Krishna. Okay, and the MoU documents, they were exchanged in the Port Louis, Mauritius, in the presence of the Prime Minister of both the countries on March 12, 2025. So this is the MoU that has been signed between the Reserve Bank of India and the Bank of Mauritius, that is the Central Bank of India and the Central Bank of Mauritius. They have signed this MoU for the use of the local currencies for the cross-border transactions. Okay, so the MoU aims to promote the use of Indian rupees and the Mauritian rupee in bilateral trade in between the countries. Whatever trade will happen, that will happen, or that is promoted to happen in the local currencies. Now the MoU covers all the current account transactions. So now when the trade is happening between the current countries, usually the trade is in the current account and the capital account. Okay, so current account is your trade in goods. So when the two countries are trading with each other, they trade in goods, they trade in services, or there is the transfer payment that happens. Okay, there is the transfer payment that happens. Okay, the capital account transactions, these are the transactions, that is the investment. Okay, let's say the India is investing in Mauritius, or Mauritius investors, they are investing in India. So those investment comes under the capital account, as well as the borrowing. The external borrowing, it comes under the capital account, and the external assistance also comes under the capital account. So all the current account transactions, it is promoted that we should use the local currencies, the Indian rupees and the Mauritian rupee, we should use for the cross-border transactions, for the current account transactions, for the trade in goods, for the trade in services, and for the transfer payments, that is for the remittances, grants and such. We should use the Indian rupee and the Mauritian rupee between the two countries. And for the permitted capital account transaction, because certain capital account transactions, they have the limit, like how much the commercial entities can borrow from outside, or how much we can lend to outside, how much we can invest in the other countries, or how much the other countries investors can invest in our country. So there are some limitations. So in the capital account, the permitted capital account transactions, that can also happen in the local currencies. So the MoU aims to promote the use of Indian rupee and the Mauritian rupee in bilateral trade. The MoU covers all the current account transactions, that is the trade in goods, trade in services and the transfer payment, and the permissible capital account transactions, where in the capital account, in the investment, in the foreign portfolio investment, in the foreign direct investment, in the borrowings, in the lending, there are the limitation. And as per the permissible capital account transactions, these transactions can happen in the local currencies. They are as agreed upon by both the countries. Okay. Now, the framework would enable the exporters and the importers to invoice and pay in their respective domestic currencies. Okay, so the exporters and importers, they will be able to make the bill invoice in their respective domestic currencies, which in turn would enable the development of a market in the INR and the MOR pair. So the Indian rupee and the Mauritian rupiah will be used more bilaterally, as the exporters of our country will require the Mauritian rupiah for the imports that we are doing and vice versa. So the Indian rupee and the Mauritian rupee, they will be used for the transaction between the two countries, and the invoices or the bills and the payment will happen in these two currencies. Before, what was happening, that the, let's say, Indian rupee, this was converted into dollars and then it was paid, the dollars was paid for to the Mauritius. Okay, now Mauritius was getting the dollars and this dollars was converted into the Mauritian rupee for providing to the exporters of Mauritius. Okay, so you can understand that there was the conversion that was happening in dollars, then the dollars were converted into the local currency. Now we are saying that instead of using this dollar and instead of taking this extra conversion, let's just directly convert the Indian rupees into the Mauritian rupee for the transactions that are happening between the two countries. So it will also reduce the settlement time, because now the Indian rupee, we do not have to convert it into dollars, and the dollars are not required to convert into the Mauritian rupiah. Directly we are converting the rupee into the Mauritian rupee, or we are directly transacting with the help of Indian rupee and Mauritian rupee, not using the dollars in between. So the use of local currencies would optimize the cost, would reduce the cost actually, because the conversion or converting the rupee into dollars and dollars into Mauritian rupee will not be required, and settlement time will also reduce. Okay, the collaboration marks a key milestone in strengthening the bilateral cooperation between the two countries, that is India and Mauritius, and between the two central banks, that is the RBI and Bank of Mauritius. Use of local currencies in the bilateral transactions, this will eventually contribute to promote the trade between the India and Mauritius, because they will not require the dollars. So dollars is not required, so it will not affect their exchange rate in regards to the dollars. The Indian rupees and the Mauritian rupee can directly be used for the transactions between the country. So this will promote the bilateral trade between the two countries, as well as deepen the financial integration and strengthen the networks between the two countries and relations between the two countries. Okay, now why this topic is very important, that the RBI and the Bank of Mauritius have signed a MoU for the bilateral transactions in the local currencies. So you can understand that the Reserve Bank of India has been continuously promoting the use of local currencies. The RBI has continuously encouraging the use of Indian rupee and the local or national currencies for the settlement of cross-border transactions. And the RBI in January released this press release where the RBI said that RBI has taken multiple steps to encourage the use of INR and to encourage the use of local or national currencies for the cross-border transactions. So you can understand that again and again the Reserve Bank of India is coming into the MOUs, or RBI is promoting the use of local currencies. The RBI is promoting the use of Indian rupee. So I had taken a session on the steps that have been taken by the RBI till now for the promotion of the Indian rupees and for the promotion of the local currencies for the cross-border transaction. And this recent MOU is a step further towards this initiative. Okay, so this is the idea. Now let's move forward to the next news article that is a little complicated, but let's try to break it down. Let's try to understand it. So RRBs have got 5 more years to amortize the additional pension liabilities. So the Reserve Bank of India has said that the regional rural banks, they will get 5 more years beginning with the current financial year, that is your financial year 2024-25, to amortize the additional expenditure in light of the revision in pension. So there is some revision in pension that has happened, and so there is the additional expenditure that is there for the regional rural banks that they can spread out. in the 5 years. So what is this whole news article that we have to understand? Then we will be able to understand this. So let's come back to this point after we have understood the whole background, after we have understood the idea of the amortization. Okay. So first of all, coming to the background, so employees of the public sector banks, they had a pension scheme, but the RRB employees did not have a proper pension structure. So the public sector banks, they had a proper pension scheme according to which the pension was given to the employees. But the regional rural banks till 2018, they did not have a proper pension structure. So to ensure that equal benefits are given to the regional rural banks employees as well as to the public sector bank employees, the RRB Employee Pension Scheme 2018 was introduced to provide a structured pension scheme for the RRBs. So basically, the public sector banks, they had a pension scheme, they had a proper structure. But the regional rural banks, for the employees of these banks, there was no proper pension structure that was present till 2018. So to ensure that the equal benefits should be provided to the regional rural banks employees, the RRB Employee Pension Scheme 2018, this was introduced, that brought a structured pension scheme for the RRB employees. Okay, so you can see that in 2018, in April 2018, this is the article that was released, that the regional rural bank employees to get pension at par with nationalized banks, with the public sector banks. Okay. So a Supreme Court verdict has paved the way for the regional rural bank employees to draw pension at par with nationalized banks, ending a 2-decade-long legal battle that was there. Okay, so regional rural banks employees, they were always complaining that we are not getting the equal benefits, we are not getting the benefits that are provided to the public sector banks. Okay, so a 20 years long battle has come to the end, and in 2018 this was announced. Okay, so the Supreme Court had highlighted the need for the regional rural bank employees to get similar pension benefits as the public sector bank employees, and that's why in 2018 there was the RRB Employee Pension Scheme that was introduced. Okay, so RRB Employee Pension Scheme, this was introduced in 2018. Now, as per this scheme, it allowed the employees who retired on or after January 1, 1986 to opt for pension benefits. Okay, so basically in 2018 there was the RRB Employee Pension Scheme that was introduced. Okay, and it allowed for the retiree employees, that is for the retired employees, they can opt for the pension benefits if they are retired on or after 1st January 1986. So if a employee has retired from the RRB on or after 1st January 1986, so they can get the pension benefits. Now this pension benefits was provided from 2018 onwards. So the original 2018 scheme allowed eligibility from 1986. So all the retired employees that have retired on or after 1st January 1986, they were eligible for the pension benefit. But RRBs weren't financially required to recognize pension liabilities before 2018. That means pension will be provided to you from 2018 onwards only. So the eligibility was that you are retired employee from the RRB from on or after 1st January 1986. But the pension will be provided from 2018 onwards, because this rule has come in 2018. Okay, so now the NABARD, this is the press release of NABARD. Okay, this is the press release of NABARD. So NABARD said that as you are aware that the RRBs are required to provide for their pension liability as on 31st/3/2018. So it was said that for all the retired employees that are retired from the regional rural bank on or after 1st January 1986, they can opt for the pension benefit, and they will be provided the pension benefit from the 1st April 2018 onwards. Okay, so all these employees, you can understand that number of employees would have retired on or after 1st January 1986. So all these employees, thousands of the employees, had to be provided the pension benefit from 2018 onwards. So as you are aware that RRBs are required to provide for their pension liability. So RRBs now have to provide this pension from 2018 onwards to all the eligible employees. So this was a pension liability. This was the obligation of the RRBs that they had to complete as on 31st March 2019, by 31st March 2019. However, considering the large amount of provision that the RRBs have to make for this purpose and the significant impact that such provision, because you can understand that this pension liability can be in crores. So it can put a lot of burden on the regional rural banks. So it was said that as this liability can put a lot of burden on the RRBs in a single year, so let's break down this pension liability in multiple years. So it was said that in this connection, the NABARD talked to the Reserve Bank of India, and the Reserve Bank of India has now accepted the request made by NABARD and has permitted the RRBs to spread out, to amortize means to spread out their pension liability over a period of 5 years. Okay, beginning with the financial year ending 31st March 2019. So this was the idea at that time, that it was said that okay, because the regional rural banks have to provide the pension from 2018, from 1st April 2018 onwards for all the employees that have retired on or after 1st Jan 1986. So for all these employees, the pension has to be provided by the RRBs from 1st April 2018 onwards. So this is a very huge pension liability. So the RRBs were provided 5 years time period where they can spread out this pension liability in the 5 years beginning from the financial year ending 31st March 2019. Okay. Now what has happened? Now why the RBI is saying that 5 years will be provided from financial year 2024-25. So actually, before in 2019, the NABARD released a press release that RRBs were earlier permitted to spread out their pension liability on account of RRB Pension Scheme 2018 over a period of 5 years, beginning from financial year ending March 31st, 2019. Now in 2024, the government released this press release, where the government said that Department of Financial Services, Ministry of Finance, Government of India has communicated to all the RRBs that the government has decided to implement the pension scheme in RRBs with effect from 1st November 1993. So basically, as on or after 1st January 1986, all the retired employees, they were eligible to adopt for the pension benefits from 2018 onwards. They would have got from 1st April 2018 onwards, they would have got this benefit, the pension benefit. That is that the employees, the retired employees of the regional rural banks that are retired on or after 1st January 1986, they were allowed to get the pension benefits, or they can accept, or they can opt for the pension benefits from 1st April 2018, from 1st April 2018. But now it is said that the retired employees that have retired on or after 1st Jan 1986, they are eligible for getting the retirement benefits from 1st November 1993. That means this the eligibility is same, but the implementation that was happening from 2018 onwards, now the implementation started from 1993 onwards. So in 2024, it was said, in 2024, the government said, the government has communicated to all the regional rural banks. So the Department of Financial Services under the Ministry of Finance, Government of India, communicated to all the regional rural banks that the government has decided to implement the pension scheme in RRBs with effect from 1st November 1993, which was currently implemented with effect from 1st April 2018. So this is the basic idea, that on or after, if the retired employees that are retired on or after 1st Jan 1986, before they were getting the pension benefits from 1st April 2018 onwards, but now they will get the pension benefit from 1st November 1993 onwards. This was announced in 2024. Now you can understand that so many of the retired employees will start getting the benefit from 1st November 1993 onwards. That means the time that has already passed. For that, the regional rural banks will have to make the provisions, will have to provide the pension for the time that has already passed also. So along with payment of the payments have to be made to the eligible pensioners or the family of the pensioners. So RRBs are now required to implement the pension scheme with effect from November 1, 1993. Before, the scheme was being implemented from 1st April 2018 onwards, but now the RRBs are required to implement the pension scheme with effect from November 1, 1993. However, in view of the difficulties that is expressed in absorbing the increased liability in a single year. So first it was said that in the financial year 2024-25, in this financial year, try to provide the pension as per the new implemented time period. Okay. So it was said by the RRBs that it is very hard to absorb such huge increased liability in a single year. So now it has been decided to provide some relaxation to the RRBs. So 5 more years are provided. 5 years are provided for this additional liability. Okay, so let's understand this. So first of all, what is the course of action? Now basically the idea is that the RRBs for all the eligible retired employees that have retired on or after 1st January 1986, they will get the pension benefits. If they opt for the pension benefit, they will get the pension benefit from 1st November 1993. From that time period onwards, that means whatever pension is accrued, that will be provided to the employees. Okay, before, this time period was from 1st April 2018 onwards. So for this time period, whatever additional accrued pension is there, that will be provided to the employees. So the liability on account of applicability of the pension scheme from 1st November 1993, this shall be fully recognized. So whatever is the liability of the RRBs, whatever is the obligation of the RRBs, whatever is the additional burden of the RRBs, so that has to be fully recognized as per the applicable accounting standards. Okay, the expenditure on account of the revision in the pension timeline may, if not fully charged to the profit and loss account during the financial year 2024-25. So basically, whenever, now this pension, it is a cost for the RRBs. Now this is the cost for the RRBs. This is the expenditure of the RRB, because the RRBs will have to spend for paying the pension from the new timeline. Okay, so now this cost or the expenditure of the RRBs will have to be shown in the profit and loss account. Let's say this is the income of the RRBs and this is the expenditure of the RRBs. Now whatever is the pension liability, that is the additional expenditure, so that has to be shown in the expenditure side, that okay, the pension liability, that is also the expenditure, so that will be shown in the expenditure side, and then from the income the expenditure will be deducted to get to the profit. Let's say income is 100 rupees, the expenditure is 90 rupees, so the profit will be of 10 rupees, right? So in the expenditure side, this pension liability will be shown. Now if the pension liability is shown only in 2024-25, so the pension liability will be huge, will be very much, and it will increase the expenditure by a lot in the profit and loss account. So it is said that rather than showing the pension liability in a single year in your profit and loss account, you can show this pension liability in the period of 5 years. Okay, any confusion anyone has in this? Any confusion here? So the expenditure on account of the pension, if it is not being able to fully charged in the profit and loss account in the single financial year 2024-25, it can be spread out. It can be spread out over a period not exceeding 5 years, beginning with the financial year ending March 31st, 2025. So in the 5 years, let's say the pension liability of a regional rural bank, the pension liability is of 500 crores. Okay. Now in 5 years, now this pension liability of the 500 crores, this will be spread out in the 5 years, first, second, third, fourth and fifth year. Okay, so in first year 100 crores, in second year 100 crores, in third year let's say 100 crores, in fourth year 100 crores, in fifth year 100 crores. So now this expenditure of 500 crores will be divided into the 5 years. Okay, and the subject to a minimum of 20% of the total pension liability involved being expensed every year. So at least 20%. So 20% of 500 crore is 100 crore. So at least 20% of the pension liability has to be covered in 1 year, in every year. Okay. So this is the idea, that if it was said that if like the eligible retired employees that have retired on or after 1st January 1986. Now they will get the pension from 1st November 1993 onwards from this timeline. So from this timeline the pension scheme is implemented. So whatever is the accrued pension till now, if the eligible retired employee is opting for the pension scheme, so whatever is the accrued pension that has to be provided to the employee. So the pension liabilities are lot for the regional rural bank. So the 5-year timeline has been provided. So 5-year timeline has been provided starting like from the financial year 2024-25. So 5-year timeline has been provided, and each year at least 20% of the pension liability has to be mentioned in the profit and loss account as the expenditure. Okay, so this is the idea that the liability has to be spread out over a period not exceeding 5 years, beginning with the financial year, that is the financial year 2024-25, that is ending March 31st, 2025. Now, appropriate disclosure of the accounting policy has to be made regarding the pension liability. This shall be made in the notes to accounts to the financial statement. Bank shall also disclose the amount of unamortized expenditure. Let's say 500 crores is the pension liability. In the first year, you are showing 100 crores in your profit and loss account. Okay, so the pension liability is 500 crores. In the first year, you are showing 100 crores in your profit and loss account. So that means the unamortized pension liability that is not shown. Unamortized means that is not spread out till now, or that is not shown in the profit and loss account till now. So that is how much? If anyone can tell me, that is how much? So that is 400 crores, right? That is 400 crores. Okay, so the 500 crores is the pension liability, out of which 100 crores has already been shown in the profit and loss account in the first year. So the 400 crores is the unamortized expenditure. This is the unamortized pension liability that is not shown till now. It will be shown in the second, third, fourth and fifth year. And the impact on the net profit if the remaining pension liability were to be immediately charged. So it has to be shown that if the unamortized pension liability is to be immediately shown in the profit and loss account, so what will be the impact on the net profit? So let's say the net profit currently is 500 crores, or net profit is currently 1000 crores. If this 400 crores of the unamortized liability, pension liability is shown, so the net profit will decrease to 600 crores. Or let's say net profit is 300 crores, and if this 400 crores of the unamortized liability is shown, so the net profit will decrease and it will become the loss of 100 crores. Okay, so it has to be shown that what will be the impact on the net profit if the remaining pension liability were to immediately charge to the profit and loss account. Okay, so what will be the impact on the regional rural banks? So bank shall also disclose the amount of unamortized expenditure that will be spread out in the later on years, and the impact on the net profit if the remaining pension liability were to be immediately charged on the profit and loss account. Pension related unamortized expenditure. So the unamortized expenditure that will be spread out in the later on years, this would not be reduced from tier 1 capital of the RRBs. The tier 1 capital of RRBs, this is, remember this, that this is the most liquid capital that any bank has. So tier 1 capital is the most liquid capital that a bank has, and this the bank uses during the time of distress. So it has been said that the RRBs should not use their tier 1 capital for their unamortized expenditure, for their pension liability, basically. Okay, this circular is applicable to all RRBs with effect from financial year 2024-25. So this is the idea. So RBI has said that RRBs will get 5 more years beginning with the current financial year 2024-25 to amortize, to spread out the additional expenditure in light of the revision in the pension scheme that has happened. The implement period has been increased, so the extra time has been granted due to the difficulties expressed in absorbing the increased liability in a single year. Now, why the government has changed the timeline? Before, the pension scheme for the RRBs, this was implemented from 1st April 2018, but now it has been said that it will be implemented from 1st November 1993. Why is it so? Why put extra burden on the RRBs? So basically, the government has decided to provide the pension to RRB employees from November 1, 1993 onwards to bring parity with employees of public sector banks, because the public sector banks follows this timeline. Okay, so to bring the parity between the employees of the RRBs and the employees of the public sector bank, this decision has been taken to resolve the long-standing demands and legal issues. I hope this is very much clear. So this is the whole news article. Okay, now before showing you the questions, let me show you that there is the perspective 360-degree series that is going on. So there is perspective 360-degree series that is going on, where you are getting the answer writing practice. Okay, so many of the students ask that where they can do the answer writing practice. So this is the perspective 360-degree sessions taken by Jaskran sir on Monday, Wednesday and Friday at 5 p.m. So here you can do your answer writing practice. Here you can do the answer writing practice. Okay, the sir will also give you a question and you can write the answers in the comment section, which will be evaluated free of cost by the team. Okay, so this is the free initiative in YouTube that you can go through. Now this is the first question. I hope you will be easily able to answer this question. So this is the question regarding the first news article that RBI has signed a MoU. So with which of the following countries? So such a lengthy question can come, but you have to find the keywords that what the question is trying to ask. And this is the second question. So try to inform that which of the following statements is incorrect, that you have to find. Okay, so I hope you will be easily able to answer this question. Now before ending the session, I want to show you that if you go to the edutap.in, you can go to EduTap's website, where in the free material you can see the blocks which are freely available to you, which are freely provided to you, so that you can get the exam information for the exam that you are preparing for. You can get the strategy for the different components in the examination. You can get the success stories in the blog format, in the written format, so that you can know that how the toppers achieve their dream, what strategy they followed. Okay, as well as if you go to the courses section in the edutap.in, if you go to the courses section, you can see the different courses that are provided by the team for a particular competitive exam, the different courses that we are providing, what all we are providing in a particular course, what off is going on, and who all will be teaching. Okay, so this is all that is provided. So do go through the edutap.in, the website, and I hope you liked the session. You were able to understand everything, and do give me the right answer of the homework question, and see you in the next session. Thank you everyone. Thank you for joining the session. See you in the next session. And if there is